Hi, everyone. We are waiting on 1 or 2 people, so hang in there. Okay, guys, I think we'll get rolling. I had to stand up. I just sat for 2 hours, so I'm not used to sitting. We are back into chapter 8, and we're going to be now focusing on tax credits. And the very end of our chapter, which I'm using a PowerPoint that's updated for the CARES Act, is about late filing, late payment penalties, and they have really been, so we're like, I don't know if it's alleviated or what, but they're much more liberal in applying them than they normally are. I mean, they're allowing you to take longer to pay certain amounts. So I want to take a look at that with you. Now, remember when you're working on your exercises and problems that if it doesn't say when you're working in the underpayment area or the late filing or late payment area, it doesn't say CARES Act. We're following what the book says, which is the more strict way of making sure that things are paid on time. And if they aren't, you're going to be assessed a late penalty. And the CARES Act, like I said, will give you the real due date, and then we'll tell you where you have some leeway with making your payment later than normal. All right, so. And the CARES Act changed it because of the whole COVID thing. So you should see reduced tax liability dollar for dollar. Okay, so tax credits. Tax deductions reduce income to get to taxable income. Taxable income is what we use to calculate tax on. Tax credits are deducted from your tax liability. So these are a dollar for dollar reduction on your tax liability itself, not on the income to determine your tax liability. So normally, if you have a choice between a tax deduction and a tax credit, you are going to take the tax credit because it's a more direct deduction to what you would owe. But I always say, work it out for your client so it's for the best way tax-wise for them. So there's 3 major categories. There's what we call non-refundable personal. Non-refundable means if the tax credit is greater than your tax liability, you will not get the excess amount in a refund from the government. So you will only be able to take the tax credit to the extent of your tax liability. So if you figured out your income tax, you said my taxable income is this much money and my tax liability is $4,000. And your non-refundable tax credits come out to be $5,000, you could only take $4,000 of them. The rest you lose. If it's refundable tax credit, that's different. Now the tax credit above your tax liability, you will receive a refund of that amount. So same scenario, $4,000 is your tax liability, $5,000 is your refundable tax credit. That excess of $1,000 you'll receive as cash from the US Treasury, just like you will any other refund of excess tax payments. There are also business tax credits, which we're not going to get into. There's just a whole list of them. We're focused on the personal ones that are common. In an advanced tax class or in practice, you'll learn about these business tax credits. So here's our first non-refundable personal tax credit. Before we do it though, we've already seen that one anyway. I'm just gonna grab our 1040 Oops, just give me a second. My keyboard is down a lot lower than I am. So let's grab our 1040 and our schedules so you can see where these tax credits are going to be. I can't believe we don't have a 1040. Wow, for 2020. Okay, so let me share this. So you're seeing the 1040 right now. There's page 1. Page 2 is where your tax credits are going to be. Here's your first major one, the child tax credit, which you already have seen on your first tax return. We're going to talk about that first. And then we have other Schedule 3 is where we'll have other non-refundable credits listed, and I'll go there in a second. And then Schedule 4 no, it's not. I'm sorry. It's line 18A, B, C, and D are your refundable credits. They don't have their own schedule. They used to last year. Now they're back on the 1040. All right, so that's where we're focused on our 1040. That's where these credits are going to go. And Schedule 3. Today we're going to talk about, wrap up all of these, well, the major ones. I think we talked about the foreign tax credit a little bit. We're going to talk about the credit for child and dependent care. We're definitely talking about the education credits. Next chapter, we'll talk about the retirement savings credit. I think we mentioned the residential energy credits, and you can see there's some others here. I'm not sure if we touch on them or not. Okay, so that's our focus right in there. And then we see that other part of the 1040 for our refundable. All right, so back to it. I'm going back to sharing my, come on, share that. I don't know if it's sharing it or not, so let me see. There we go. That's that. Share it. Did you guys see my PowerPoint? Oh, I see. Playing games with me. It should be coming now.
I can see it.
Yes? Oh, yep, there it is. Okay. All right, let me, so this is our first one. You receive a $2,000 non-refundable credit for each qualifying child. So now you're going back. Is my dependent a qualifying child or qualifying relative? If they're a qualifying child and under the age of 17 at the end of 2020. So if they turn 17 during 2020, you don't get it. They don't qualify for this one. They have to be 16 or under. Then $2,000 for each occurrence of a dependent like that. Tax credit. Now, there is a little part of this that if your tax liability is less than your tax credit, you may be eligible for a part of it to be refunded to you. So a part of this could become a refundable credit, but generally it's a non-refundable credit. Now, what about that child, that qualifying child or other dependent you have that isn't under 17? You receive $500 tax credit for each occurrence of that. So they don't have to be a qualifying child for the $500. So all other dependents and any qualifying child 17 or older qualify for the $500 each. So it's not in total, it's each dependent. You have to look at them individually and add them all up. Now there is a phase out. And what I love about this, because this changed during the CARES or during the TCJA, Tax Cut and Job Act, TCJA, back in 2017. So I probably have told you guys, like every time there's a major tax change, something fabulous is happening for people, I usually get screwed, right? So you guys know that, you know, student loan interest started getting deductible when I graduated, or I finished paying off my student loan. Education started getting tax deductible after I finished my master's degree. You know, so there was always something. So let's talk about the child tax credit. In 2018, before 2018, I should say, the child tax credit was still available to people, but it was $1,000. And if your income was at a certain level, and it was like 100, I don't know, it's like, no, even $80,000, you didn't qualify for it. You phased out. You couldn't take it, right? So back in 2017, my son is 2017, he was 16, okay? I made too much money. I was head of household back then because I still wasn't married. I was divorced, head of household. I made too much money to take the child tax credit. 2018, I'm married now. The phase out starts at 400,000 of adjusted gross income. I'm like, woohoo! Nowhere near AGI of $400,000. I could get a $2,000 tax credit for my kid. I couldn't. He turned 17 during 2018. I can't win. So what did I get? 500. Whoopee. Okay. But just, you know, just a little personal story there. But be careful of that. Let's talk about that phase out. It's not in there. So if you go to page 825, so the phase out is a lot higher than it once was. So you don't get child tax credits, or they start phasing out when you're married filing joint and your income, let me verify that, AGI is $400,000 or more. If you're single or married filing separately or head of household, it's 200,000 or more. Even then, I would have been able to claim them, you know, get all of that amount. Nope. Because I don't make $200,000. So how does it phase out? Take a look on page 825, example 817. We got both Ellen and Duran are Courtney's qualifying children. Courtney can claim a $2,000 child tax credit for Duran because he's under 17, blah, 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 blah. Okay. Okay, for the other kid, she can claim a $500 credit because they're over 18 or over 17. So her AGI that's been running all along was 187,000. So because of that, she could take $2,000 for the qualifying child who's under 17 and $500 for the qualifying child who's over 17, $2,500. Now, if that other qualifying dependent was like her parent, I still think she's cool with that $500. So it does not need to be a qualifying child for that 500. They're just that qualifying relative. The only exception, I mean, I'm pretty sure on this. If the dependent does not, that qualifying relative, if they don't live with, if they only qualify because they live with you, I don't think that qualifies. I will double check on that. That's sticking in my head. I hope I didn't say something I wasn't supposed to there. Let's see. I'm just looking at the footnotes. I'll double check on that, but something's in my head saying that's the case. Anyway, let's go what if. Now let's say Courtney's AGI is 230,000. So she's head of household. She's above 200,000. Here's how she phases out her child tax credit. AGI is 230, phase out's 200. Subtract the difference, see how much she's above the phase out, 30,000. You divide that difference by 1,000 because this is going to phase out $50. $50 for every $1,000 you're above the phase out. So we want to see how many times, how many thousands is she above the phase out. So that's where the 30 comes from. Now multiply that by the $50. So $1,500 phases out. So before the phase out, she could deduct 2,500, subtract what the 1,500 phase out because her AGI is above the threshold. So she can only take a child tax credit, non-refundable, for 1,000. Take a look down in your footnote on page 824. Sorry, I was reading something else there. The child tax credit is partially refundable. Remember, we said normally, if your tax liability is less than the child tax credit, sorry, you lose it. But it says, well, it could be partially refundable. The $500 child tax credit for qualifying dependents other than, there is where it is, other than qualifying children is not refundable. So what I was just saying, if it's a qualifying relative, they are okay for a non-refundable child tax credit, even if it's somebody who just lives in your house. But if you're looking for the child tax credit to become refundable, only the credit related to a child, even if they're a qualifying relative, but only a child in that state qualifies here. The refundable portion of the credit is the lesser of $1,400 for each qualifying child for which the $2,000 credit is claimed, or the taxpayer's earned income excess of $2,500 times 15%, or the amount of the unclaimed portion of the non-refundable credit. So what this is saying is you're going to compare these three amounts, and the lowest of these three is what you may be able to get refunded to you. So we just want to make you aware of it, that it is out there. You won't have to do any work with it. Next one. This one has been around forever. It was around when I was in college, and it's still at the same amount. Child and dependent care credit. This is to help people who have to work and put their child or dependent who meets certain qualifications into a care situation and pay for it. Now, who must qualify? It's a dependent on the taxpayer's tax return who's under the age of 13 at the end of the year. If the dependent is disabled, it doesn't matter how old they are, they qualify. Now, the key is, if it's a single person, they have to work. If they're married, okay, one of them has to, or they both have to work. They both have to work or go to school. Otherwise, no credit. So what are we talking about here? If you have a husband and wife and they're married and the husband works and the wife says, I'll care for the kid at home, which is great. Oh, but I need time to myself. I'm putting that kid in daycare 3 days a week so I could just have my time. That's not what we're talking about here. That wife has to work. Okay, so that's number one. The amount of the credit is based on looking at three amounts. The lowest of the actual expenditures for one or more qualifying persons. So what did you actually pay? You compare that to a maximum allowable expenditure amount that's set up by the IRS, and that's $3,000 for one or $6,000 for two or more. The third amount is the earned income of the lower spouse. So if it's a married filing joint, we look at the earned income of both spouses, whichever one is lower. So it's the actual amount paid, that earned income, or the statutory amount. Take a look at the footnote at the bottom of page 825. It says, If the lesser earning spouse cannot work due to a disability, that's another little caveat, or is a full-time student, full-time, not part-time, full-time, the lesser earning spouse is deemed, so we pretend, to have earned $250 a month for purposes of calculating this credit. So we'll go through an example of that. If they have more than one dependent, it's assumed they earned $500 a month. So there is a little exception there. If you're trying to go to school and you got to put your kid in daycare because you're trying to go to school, well, come on, that's not fair. So they're giving us a little break here in calculating this credit. Now, once you determine which of those three amounts, earned income, the actual expenses, or that statutory amount, whichever is lowest, that's not your credit. Your credit is then calculated. You take that amount by a percentage that's determined by AGI. So if your AGI on your tax return is between 0 and 15,000, you get a 35% credit. And then you could see the different percentages. Once your AGI is above 33,000, it goes even more, I think. Yeah. Once your AGI goes above 43,000, you're limited to 20% of those, the lowest of those three amounts. So this table is in your book. So let me fly out of here and show you what the heck this is all about. They just give you a little overview there. You should see my Word document. Let me make that a little bit bigger there. Okay. So again, one more time. First, expenses to determine child and dependent care. Don't get this confused with the child tax credit. Child tax credit is just they're under 17 and they're your qualifying child. Bingo, they qualify. This is different. This is you're actually putting them in a care situation that you have to pay for, which, by the way, a babysitter counts, even if it's like a relative, not a younger sibling. But if it's like your mother watches your child for you and you pay her, make sure she puts that as income on her tax return, okay? But you can use that. You know, taking the child to the YMCA or the little people or whatever the heck they call those, you know, they all qualify. There's certain things that don't, but we're talking generals here. So the first thing is the actual care cost. Second thing is $3,000 for one, $6,000 for two or more. Okay, so again, this is the lowest one of these three calculations, is what qualifies you to calculate it. 3, the lowest earned income of the spouses, if there's more than one person. If disabled, so if the lower earning spouse is disabled or full-time student, it is assumed that they earn $250 a month for one child in daycare or $500 for two or more. Once we determine the lowest amount, take the lowest amount times the percentage that's based on AGI. And that equals your child and dependent care credit. They don't have to be a child, it could be an adult. You know, there are disabled adults, people need to work, they put them in adult care. Once that disability comes in, age doesn't matter. So we have John and Sue have a 3-year-old in daycare. They pay $2,700 a year for the care. John earns $50,000 a year. Sue is a full-time law student 9 months of the year. What is their child and dependent care tax credit? Now remember, this is a non-refundable, and this is totally non-refundable. No part of it ever becomes refundable. So we do the actual care cost, $2,700. Statutory limitation. If it's one child and dependent in care, then it's $3,000. So that's the most that can be. What's the earned income of the lower earning spouse? Well, one spouse makes 50, one makes 0. But since Sue is a full-time student, take $250 because they have one child times the number of months she's a full-time student. So $2,250. So you compare those three, you take the lowest amount. It's the $2,250. Now we need to know their adjusted gross income. Well, we can tell with, assuming nothing else is happening in their life, their AGI has to be John's earnings, 50,000. So once your AGI hits 43,000, you're only eligible for 20% of that lowest amount credit. So multiply that by 20%. Hey, 450 is better than nothing. So that would be their non-refundable child and dependent care tax credit. Reduces their tax liability, dollar for dollar. Now, if their tax liability is less than $450, they lose it. They can only take it to the point that they wash out all of their tax liability or eliminate it. So none of that is refundable. I know that's kind of weird, but does anybody have any questions on it? I just want to see if there's anything else here I want to point out. Okay, when you actually fill out a form for this, 8863, I think, off the top of my head, I don't remember. But on there, they ask you for the tax ID of whoever provided the care to the child. So that's if you're going to pay your relative. Now, as I said, you can't pay a younger sibling. They don't qualify. You can pay them, but you can't take a child and dependent care credit. But if it's an older relative and they, like your mom, and you pay her, $2,000, they're going to want to know her social security number to make sure she claims that $2,000 as income on her tax return. So just be careful of that. Okay. Heading back over to our slides. All right. So we're getting into the fun ones. The ones that came out when I finished everything with school. Can't win. This was called, isn't this funny? No, it was called something else. Not the, oh, God, it had an old name. But anyway, back in the 1990s, around 1998, Congress enacted 2 tax credits for education expenses. Now, remember we talked about you can take a deduction for AGI for your education expenses up to $4,000 if you meet those AGIs, or those expenses you can use instead and take a tax credit. So you would work it out both ways. Now, The current tax credit that's really nice is the American Opportunity Tax Credit. Who takes this? The person who claims the student as a dependent. So if you're still being claimed as a dependent on your parents' tax return, they get it. If you claim yourself, you get it. A student is only eligible to have this tax credit for their first 4 years of post-secondary education. They have to be more than part-time. Okay, so you can't be part-time to be eligible. And if you're somebody who's been a freshman for 4 years, sorry, you're done after your first 4 freshman years. So you can't say, I'm still a freshman, you know, in your 5th year or whatever. You have to, it's only the first 4 years. Now, only eligible expenses qualify. And again, these are ones that are paid for, basically tuition, fees, looking for tuition fees, course materials that are needed for the course at an eligible education institution. And they go on and define that even more. And you can look at that in your footnotes on page 827. Again, loans qualify if you have to pay them back. They're considered part of the eligible expenses. But things like, and I know it's right here. By scholarships received as reimbursements for Pell Grants. Yeah. So if your parents are like, hey, like I do this with my son right now. He's a freshman, or oh my God, he's a sophomore at Penn State, Wilkes-Barre. You know, I have a 529 plan for him. So, which is a savings account I started way back when he was born, that I pay for some of his education through that. That's not eligible for this. Okay, because I got a tax break because I don't have to pay taxes on the earnings from that 529 plan. So I can't deduct anything as far as that goes with claiming this credit. But if you have a loan or out-of-pocket expenses, they qualify. This is a per student tax credit. So the taxpayer, taxpayer's dependents, third parties on behalf of the taxpayer's dependents can take this. Amounts paid by dependents are treated as paid by the taxpayer. So I'll have students come up to me and they go, I had to work all summer and I paid for that. Why does my parent get the, sorry, your parents still claim you as a dependent. They get to take the tax credit, work it out with them. Okay, sometimes parents will say, well, here's that extra money we got. You don't bypass the tax credit because you're fighting with each other, okay? How much do you get? You get an American Opportunity Tax Credit of 100% for the first $2,000 of eligible expenses per student in the first 4 years of post-secondary education. And then 25% of the next 2,000. So there's your 4,000 magical number that you could have deducted as a deduction for AGI. Now instead, you can take it as a tax credit, $2,000, dollar for dollar, and then 25% of the next $2,000. So the maximum credit per student is $2,500. And notice I keep saying per student. So if you're a taxpayer who has 2 or 3 kids in school at the same time in their first 4 years, you can calculate this for each of those students. And if you get the maximum credit, you can have up to a $7,500 total American Opportunity Tax Credit. That's pretty nice. Now, there is a phase out, and it is a low-end AGI phase out. It starts at if you're single, you know, so if you're anything other than married filing joint, 80,000 it starts phasing out at, and it totally phases out at 90,000 of AGI. If you are married filing joint, starts phasing out at 160, totally phases out at 180. So you want to keep that in mind. If you can't take your entire American Opportunity Tax Credit, up to 40% of it may be considered a refundable credit. Okay, and the requirements for that is down at the bottom of page 8-27, footnote 34. And they talk about that. Wait, is that it? Yeah. Okay, so in those footnotes, you get some more information. So let's see this thing in action. Courtney paid $2,000 of tuition, $300 for books for Ellen to attend the University of Missouri, Kansas City during the summer, following the end of her first year. What is the maximum American Opportunity Tax Credit before phase out Courtney may claim for these expenses? Well, assuming, and there's another little caveat here, and unfortunately I got to say this, if the student was convicted of a drug felony, they are not eligible. The money is not eligible for the American Opportunity Credit. I don't know why, but it was just a trade-off they had. I think if you were convicted for a drug felony and now you're back in school, they should probably say, good for you, but that's what they do. So because the cost of tuition and books is an eligible expense, Courtney may claim a maximum AOTC, American Opportunity Tax Credit, of $2,075. The first $2,000 is dollar for dollar, 100%. The next $300 is 25%. Remember, she could go up to $4,000 there. Now that's before phase out. Let's see what happens if she has phase out. Phase out. So how much would Courtney have been allowed to claim if she were married and filing a joint return with her husband and their AGI is 162,000? Now watch how this phases out. AGI is 162,000. It starts phasing out this credit 160. So the excess is $2,000. That's the amount her AGI is above phase out threshold, the lower end. It phases out over a $20,000 range. So divide the excess by that range. So 10% of her credit phases out. So multiply the 10% times the total credit you're allowed before phase out, not the $4,000, but the total amount you're allowed from your expenses. So 208 is not allowed. Take the difference between the 2,075 and the 208, and there is her phase out, or her American Opportunity Tax Credit, $1,867. Okay. Now, let me see. Okay, let's go back here. What if you're in your 5th year of your freshman year, right? I kid around about that, but that's okay. Hey, take your time, get to where you want to be. You got to do this stuff for the rest of your life. Well, all hope is not lost. If you are a part-time student, if you are just taking a class here and there once in a while, you're not even on a degree track, you're taking continuing education, maybe for your CPA license. If you are, convicted drug felon or in your 5th year of your freshman year, you're out of that 4-year gap, there's another credit your expenses are eligible for. Now, they're for any course, the tuition for any course of instruction to acquire or improve your job skills. So not only is it your undergraduate work, but your graduate work, your doctoral work, continuing education seminars. The difference between this and the AOTC is it's a per taxpayer refund. So if you still have those 3 kids and now they're all in graduate school, you can't calculate this credit for each of those kids. You have to look at it as aggregate. What are all of their expenses that we paid out of pocket or they're going to pay back with loans? Up to $10,000 of those aggregate expenses qualify, but then only 20% of that eligible expense up to 10,000 is allowed as a lifetime learning credit. Again, phase out, phase out, phase out. Phase out begins here at a different range. It's much lower. For a non-married filing joint, 59,000 AGI to 69,000. For married filing joint, your lifetime learning credit phases out from 118 to 138. So much lower. Okay, I talked about this. Now, before I go into, let's put these into action here. Get my keyboard. Oh, all right. Now, just so we clarify, none of this is deductible, refundable. Lifetime learning credit is not refundable at all, like the American Opportunity Tax Credit. Okay, so if your lifetime learning tax credit is above your tax liability, you lose the rest of it. So let's say, let's find somebody new here. John keeps calling in. Mike and Bonnie are married filing joint. Their son is a graduate student and 23 years old. He qualifies as their dependent. Their daughter is in her 6th year of college. She changed her major a couple times. And 22 years old. I guess she would be a little bit older than that, huh? 19, 20, 21, 22, 23. Yeah, she'd probably be about 24. We'll say she's 22, 6th year of college. She started early. They paid $7,000 for son's tuition and $6,000 for daughters. Now remember, it doesn't matter if these two go to school full time. It doesn't matter if they have drug felonies. It doesn't matter, you know, it's kind of like the lifetime learning credit catches all those people that couldn't qualify for the American Opportunity Credit and still giving them some kind of a tax credit for going to school. And they both, so we know, they both qualified to be claimed as dependents on Mike and Bonnie's tax return. Mike and Bonnie's AGI is $115,000. Oops, sorry, make that 120. I thought I was in that. What is their lifetime learning credit? First of all, what are the qualifying expenses? Qualifying expenses are tuition, right? $7,000 plus the $6,000. And that's assumed to either have been paid out of pocket or through loans. So none of that was scholarship or 529 plans or grants that aren't being paid back or financial aid. So remember, this is a per taxpayer, so it's a per tax return. Mike and Bonnie have to have a choice. Well, not a choice, but they take the lesser of the 13,000 or 10,000. That's first. So although the qualifying expenses are more than 10,000, 13,000, they can only take a credit on up to 10,000. Then multiply that by 20%. So right now, before phase out, they qualify for $2,000. But just like we did for the AOTC, we need to calculate the phase out. So we start with the lifetime learning credit, $2,000. And we have their AGI, which is 120. The phase out begins at 118,000 of AGI for married filing joint. So let's take the difference. So the excess is $2,000. The range, so it phases out between 118 to 138, so the range is 20,000. So the phase out percentage will be 10%. 2,000 divided by 20,000. So we'll phase out 10% of 2,000 or 200. So the lifetime learning credit allowed will be the 1,800. Okay, that will be what they determined it to be before phase out minus the phase out amount. So, hey, still not bad. 1,800, I'll take it. That's a tax credit. You just reduced your tax liability, $1,800. Not bad. Are there any questions on it? I'd like you to go to page 830 then. So those are your non-refundable credits. There are one or two others, but these are your normal ones. These are the ones you're going to see that are the most used. Your child tax credit, your child independent care credit, your education credits. And remember, child tax credit can be partially refundable if you qualify, and so can your American Opportunity Tax Credit. So remember, that means if your tax credit in those two tax credits are more than your tax liability, you can determine if any of those can be considered refundable. So you'll get that money back. Go back over then. Okay. Now, refundable credit. This credit will be refunded to you. So these tax credits we're talking about, when a tax credit is refundable, even if you have zero tax liability, you will get this as a refund. You will get this money in direct deposited or written in a check from the United States government. It's a negative income tax. Now, it's the most abused tax credit and the one that causes identity theft. So ever since we started going and completing our tax returns online and submitting them, it has been so much easier for people to commit identity theft. And they do that in order to claim the earned income credit in your Social Security number and get free money, basically, from the United States government. Isn't that nice? So, as a tax preparer, we have due diligence out the wazoo to try to make sure that the person asking us to claim this earned income credit, one, qualifies, and two, is the person they say they are. So we have to check their ID, even if you know the person. It's kind of like I think about when the one time I went to the baseball field, what the heck, up at Montage with my mom, my dad, and now my mom's 78, so she was probably in her mid 60s, later 60s, and we went to get beer, and the guy's like, "I need your card." My mother's like, "Are you serious?" She goes, "I just walked all the way over. I'm old." He goes, "I'm sorry, I need to check your ID." I said, "Oh my gosh." He goes, "Just show me anything." But That's what we have to do as tax preparers now. So you will learn more about this out there in the field, especially when somebody's claiming the earned income credit. But no, we just don't hand this credit out to whoever asked for it. It's not like it used to be. Back when we did everything on paper, we knew, you know, the person came in and they signed that tax return in front of us and we knew exactly who they were. And now that we're virtual with a lot of stuff, hey, you got to do a lot of extra work. So who qualifies? First of all, the person must have worked. So that at least if it's a married filing joint, at least one of them had to have worked. If they're single, they had to have worked. They either worked at a job or they have their own business. Second, if they are younger than 25, okay, or more than 65, they have to have a qualifying child, at least one. If they don't have any qualifying children, they have to be 25, at least 25, but less than 65. So if you have a qualifying child, it doesn't matter how old you are. But if you don't have a qualifying child, you have to be at least 25, but you can't be 65 or older. And you can't be claimed as a dependent of another. Now, this is the schedule we use, and this is on page 8-30 to figure out what the earned income tax credit is for a taxpayer. I think there's an example in here. Okay, so let me go back here. So the first table here is for people who are married filing joint. That's the table they'll use. You notice qualifying children are over here on the side. So that's what you first focus on. Then we start going across, and I'll show you how to use this table. Everybody else uses this table. Okay, so let's do an example. Let me get my Word document back. So this is the earned income credit. It's a reward to people who are in high income wage earners, okay, for going out and working. So let's say we have Sue has one dependent child. She files head of household. And earns $25,000 at her job, which is also her AGI. Okay. Sue files head of household. She has one dependent child. She works. She earns $25,000. Okay. And that's also her AGI. So go to your table on page 8-30. We're going to go to that bottom part that says all taxpayers except married taxpayers filing joint returns. Okay. The first thing we do is we actually go to column 3. We're going to go to the row with a 1 in it because she has one qualifying child and go across. Column 3, her maximum credit is $3,584. So that's her starting point. Column 4 says phase out for AGI or earned income if greater over this amount. So what we have to do here is calculate a phase out. Since her AGI and earned income is above $19,330, she's not going to get the maximum credit. What she does first is take the difference between her AGI of $25,000 and that phase out of $19,330. And then multiply that difference by the next column, 15.98%. So if her earned income was less than 19,330, she would have received the entire, well, I shouldn't say that. Okay, she has to make at least $10,540. Okay. And when she makes that, she's eligible for $35.84. But once she makes more than 19,330, now she starts phasing out. So that difference is 5670. Multiply that by 15.98%. So she will reduce the maximum by $906. So her earned income credit, refundable, even if her tax liability is zero, will be 584 minus 906, whoops, $2,678. $2,678. Not bad. Okay, so it's like she puts this on her tax return. It's like she paid that money in. So if she doesn't have to pay the tax, there's no tax, she gets all that money back. It's treated like a tax payment by the taxpayer. So if you don't have the tax liability, you get it all as a refund. Refundable credit. That's why it's so abused. I think we went through that. Are there any questions on that? Let's see if there's anything else here. Be careful of who qualifies. Taxpayers earned income up to a maximum amount. Okay, so if you take a look on page 8-3, that first column is, okay, here's the maximum earned income eligible for the credit. So the question becomes, well, what if her earned income was $8,000? Take 8,000 then times 34% here for Sue. And that would be her earned income credit. Okay, so if she has earned income of less than 19,330, she doesn't automatically get that 3584. Her earned income has to be at least that amount in the first column. If it isn't, multiply the earned income by the percentage in the second column, and that's the earned income tax credit. And that's how that works there. Any other questions? Questions? Okay, so let's go back here. So there's our tables. A new refundable credit only applies for this year. So it's not on your 2019 tax return. Remember back in April and May, the government was sending out checks to people. They said it was a rebate. Well, not everybody received it. I almost didn't get mine because my tax return was screwed up. But anyway, I found a way around it and I got my money. But in 2020, eligible individuals can claim a recovery rebate credit of $1,200, $2,400 if you're married filing joint. And if you have a qualifying child on your tax return from 2020 under age 17, another $500. So this is in addition to that child tax credit. An eligible individual is any individual other than a non-resident alien or an individual who can be claimed as a dependent. Now, this 2,400 or 1,200, 500, however you have to add it together, is reduced by 5% of the taxpayer's AGI that's in excess of 150,000 for a married filing joint, 112,500 for head of household, and 75,000 all other taxpayers. Now you can calculate this, but if you were one of those people who got that rebate check like I did back in April or May, you subtract what you received from your calculation here. So this is really for people who never received that money or didn't receive the full amount. I don't know if they have no. So we can go through a quick example here so you can see it. Back to my Word. This is from the CARES Act, obviously, because it's something that just came out during 2020. So, okay, we have Tim, who claims his dependent qualifying child on his 2020 tax return. Tim files head of household, and his AGI is $118,000. He did receive a recovery rebate of $1,800 for whatever reason. Okay, so he did receive some of this. So does he qualify for any of this additional credit, refundable credit? Well, first of all, he would qualify for $1,200 for himself plus $500 for the qualifying child, $1,700. However, because his AGI is above the threshold is $112,500 for head of household. What we do is we take the taxpayer's AGI minus the threshold and multiply that by 5%. And that's the phase out. So his AGI was 118,000 minus 112,500. $5,500. I'm breaking the place. 500 times 5%, $275. So of the 17, oh shoot, he got too much money, didn't he? We're gonna have to change that recovery rebate. I didn't realize what I was doing there. He wouldn't have received 1,800 last year. He would have received a lower amount. Of the 1,700, he's eligible for 1,425. So if he never received any kind of recovery rebate, he would put that on his tax return and ask for it. Well, let's say instead he only received 1,000 or 1,200 even. He forgot to do something with this kid. Well, subtract that 1,200, and now he could ask for, as a refundable credit, that $225 difference. So that's how that works. It's only this year because unless there's some other kind of stimulus package that comes out in 2021, which I know they're working on one, but who knows? So we'll see what happens next year. So this is just something brand new for this year and may go away this year. And it's there to catch those people who never got the recovery rebate during the whole coronavirus thing from the CARES package. Excuse me, I'm losing my voice. Let's go on back then. Business tax credits. So to promote certain business behaviors, the government has given out the ability to take tax credits. That's just what you need to know. Okay. Like I said, you'll learn about those in another, in a more advanced class, or right in your practice when you get in there. There are, some of them are listed on page 8-33, and you'll see it says type of credit, and it says business, 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 etc. So there is a residential energy credit. We just didn't get to touch on that here. We'll talk about the savers credit in chapter 13. There's an adoption expense credit. We just didn't talk about it. There is a credit for being old. Okay, these are not widely as used. That's why they, so you can read about them, grab the 1040 instruction booklet and find out how you can claim those. So we just want to touch on the common ones. The order you take tax credits in, first, you take non-refundable personal credits, anything that is higher. So if you wipe out your entire tax liability in that first round, any excess is lost. Some, remember, you may be able to get them, a portion of them classified as a refundable personal credit. If you have business tax credits, you take those next. Any that aren't allowed because they're more than the amount of tax liability left can be either we carry them back or carry them forward. So we can actually apply them to a prior year tax return or carry them and try taking them in future years. And then last is your refundable. And it doesn't matter what your tax liability is at that point, because it's like extra money that's being refunded to you. So that's why we do that last. So those are our tax credits. Woo-hoo, we got through them. I got a few more minutes here. So the last part of your chapter talks about prepaying money. We live in a pay-as-you-go or pay-as-you-earn tax country. So when you work, your employer is consistently taking withholding, federal income tax withholdings out of your check and sending them off to the federal government. So you don't need to worry about it. But what if you don't have a employee job? You are a sole proprietor or partner in a partnership, or an owner of an LLC. Well, then you have to make what's called estimated tax payments. And these are due April 15th of each year. Now, this year, because of the CARES Act, they extended that till July 15th. June 15th is the other normal date, September 15th, and then January 15th of the following year. You are supposed to pay in your tax liability at least over that time period. Now, what if you don't? Well, how do we know if you didn't pay enough or not? And that's what's down below here. It's called the safe harbor provision. So you will be penalized for not paying enough money in during the year if you don't pay in at least 90% of your current tax liability. So if your current taxable income on this year's tax return is like $100,000 and your tax is computed to be $30,000, you should have paid in at least 90% of that, or $27,000. The other consideration is, let's say you didn't pay in $27,000. The next question is, did you pay in 100% of last year's tax liability? So let's say your tax liability in total for the prior year was $20,000 and you paid in $22,000. You didn't pay in 27, but you paid in at least 100% of last year. So you're okay. Now there is a little exception here for people with AGI greater than 150,000. You need to pay in at least 110% of last year's. If you don't meet either of those, you're going to be issued an underpayment penalty on your taxes. And this is to just stop people from not paying their taxes on time. Now, what is it? Well, what they do is they say, okay, you should have paid in 90% of this year's. Divide 90% by those 4 payments you should have made. So you should have paid in 22.5% of your current year tax liability at each of those payments. It's normally April 15th, but they made it July 15th, June 15th, September 15th, and January 15th. It'll be January of 2021. Or if, 100% of last year's divided by 4, you should have paid in 25% of that each payment. And then we compare it to what you actually paid. So the payment penalty, and that you get assessed an extra amount, is what you should have paid in each payment date minus what you actually paid in. So how much did you underpay each payment date times the federal short-term interest rate, which they give you, plus 3%. Now, under the CARES Act, so this is a little exception, the employer portion of self-employment tax. So remember, usually people who are paying an estimated taxes are, I know I'm going a little bit over, but just hang in there with me a second. When they're paying an estimated taxes, if part of that estimated payment is for self-employment tax, half of it is considered the employer portion. So essentially it's saying if you paid in what you were supposed to with your income tax and the employee portion of your self-employment tax, at least half of it, then the other part won't be subject to this calculation, this extra penalty. Okay, so what I'm going to do is, I think I only have a few more slides anyway, but I'm going to create a little more of a lecture on this because I know I'm over my time. So and I'll run through a calculation because I'm pretty sure you have to do one in your practice. It might be like 5 or 10 minutes more. I'll put it out in Canvas for you. Are there any questions right now? I know that was a lot. So now we want you to be working on then Chapter 8's requirements. And then next week we'll come in and we'll talk about Chapter 13. We're getting into our retirement plans. Okay, so if you have any questions before then on any of these calculations, just jet me an email. But otherwise, have a good weekend on Tuesday.
Professor Dunn,
Yes,
I do have a question.
sure.
So it's regarding our practice problems for Chapter 10. I'm not sure if you're able to pull up the certain questions that I have, but it's regarding, so it's question 5 for me, and it's about Carson and how he's 23 years old and he's a full-time student and he has a job, yet he has dividends coming in. I'm just not sure of how to properly, because I got the question wrong and I'm just not able to figure out what I'm doing wrong.
Let me just go in there. Let me grab your, it was in the practice for Chapter 8.
Yes.
Okay. I thought you said 10. I was like, okay, let's see. All right. Yeah, it's probably that he's subject to the kiddie tax.